The market is speaking in whispers today, but those whispers carry the weight of tectonic shifts beneath the surface of global finance. The pulse. Look at the global chessboard this Tuesday. The Dow closed down 0.42%, the S&P 500 fell 0.61%, and the Nasdaq dropped 0.89%. But these numbers tell only the surface story. Beneath them lies a more profound narrative. The market is undergoing what we might call a reality recalibration. The Fear and Greed Index sits at 41, firmly in fear territory, but this is not panic fear. This is analytical fear. The fear of institutional money managers who are beginning to price in structural changes they can no longer ignore. The market psychology today reflects a collective awakening. For months, institutional investors have been operating under assumptions about technological dominance, geopolitical stability, and monetary policy trajectories. Today, those assumptions are being stress-tested. The volatility we're seeing is not random. It's the sound of trillions of dollars in capital being repositioned as smart money recognizes that the rules of the game are changing. The stock signal. 3 moves today reveal the deeper currents reshaping global equity markets. First, look at the semiconductor complex. NVIDIA, the crown jewel of the AI revolution, declined 1.2% on what appeared to be modest volume. But sophisticated investors are reading a different signal entirely. This move coincided with Samsung's announcement of breakthrough progress in their custom AI chip development and reports that 3 major cloud providers are accelerating their internal chip design programs. The market is beginning to price in the end of NVIDIA's near monopoly on AI infrastructure. This is not a daily fluctuation. This is the first tremor indicating that the AI hardware landscape will become far more competitive, far sooner than most anticipated. Second, observe the financial sector's divergent behavior. JP Chase gained 0.8% while regional banks continued their steady decline. This spread is telling a precise story about the market's expectations for Federal Reserve policy and credit market conditions. Large money center banks benefit from rising interest rates and credit expansion, while regional banks face mounting pressure from commercial real estate exposures and deposit flight. The 150 basis point spread in performance between mega banks and regional institutions reflects institutional investors positioning for a bifurcated financial system, one where scale and diversification become existential advantages. Third, the energy sector's complex dance deserves attention. ExxonMobil rose 1.4%, while renewable energy stocks fell across the board. This is not simply about oil prices. It reflects a sophisticated recalculation of energy transition timelines. Recent geopolitical developments have forced institutional investors to acknowledge that the transition to renewable energy will take longer and be more volatile than previously modeled. Smart money is positioning for what analysts now call the extended hydrocarbon bridge, the recognition that traditional energy infrastructure will remain critical for decades, not years. The crypto layer. Cryptocurrency markets today are providing a masterclass in divergent risk assessment. Bitcoin declined 2.3% to 41,200, while Ethereum fell 3.1%. But the real story lies not in these moves, but in their timing and relationship to traditional markets. Crypto's weakness today came precisely as the dollar strengthened and 10-year Treasury yields rose to 4.28%. This correlation reveals something crucial. Cryptocurrency is now behaving more like a traditional risk asset and less like the uncorrelated alternative it was designed to be. When institutional money faces pressure in equities, it's now selling crypto alongside growth stocks rather than using digital assets as a hedge. But look deeper at the institutional flow data. While retail investors sold crypto today, blockchain analysis shows that large wallet addresses, institutional holders, were accumulating on the dip. This suggests a bifurcation in crypto market psychology. Sophisticated investors view today's weakness as a technical correction within a longer-term adoption cycle, while retail investors react to daily price movements with emotion rather than strategy. The crypto market is also reflecting broader concerns about regulatory clarity. Today's decline coincided with reports that multiple jurisdictions are coordinating on digital asset frameworks. The market is pricing in the likelihood that the Wild West phase of cryptocurrency is ending, replaced by a regulated but potentially less explosive growth environment. The geopolitical lens. Geopolitical forces are quietly reshaping commodity flows and capital allocation in ways that will define market dynamics for months ahead. In Eastern Europe, tensions surrounding Ukraine's grain export agreements are creating subtle but significant moves in agricultural commodities. Wheat futures rose 2.1% today, not because of weather or demand, but because shipping insurance rates through the Black Sea corridor have increased 40% in the past week. This matters because it signals that geopolitical risk premiums are being systematically repriced across commodity markets. Meanwhile, China's announcement of infrastructure investments in Southeast Asia is redirecting capital flows in ways most Western investors are missing. Copper futures gained 1.8% today, driven not by U.S. economic data, but by Chinese demand projections tied to their Belt and Road expansion. The market is beginning to recognize that global commodity demand will increasingly be driven by non-Western economic development, requiring a fundamental recalculation of supply and demand models. In the Middle East, Saudi Arabia's decision to extend oil production cuts through the second quarter is creating fascinating dynamics in energy markets. Oil prices rose modestly, but the real signal is in currency markets. The Saudi riyal is strengthening against the dollar, indicating that the kingdom is successfully using supply discipline to support both energy prices and its currency competitiveness. Perhaps most significantly, today brought news that 5 additional countries are preparing to apply for BRICS membership. The market impact was subtle but real. Emerging market currencies strengthened against the dollar, and gold gained $18 per ounce. Institutional investors are beginning to position for a more multipolar global economic system where dollar dominance faces systematic challenges. The intelligence edge. Connecting these signals reveals a unified thesis about our current moment in global financial markets. We are witnessing the early stages of what historians will likely call the Great Recalibration. For 2 decades, markets operated under certain assumptions. Technological disruption would follow predictable patterns, geopolitical power would remain concentrated, monetary policy would be primarily domestic, and globalization would continue deepening. Today's market movements signal that sophisticated investors are questioning all of these assumptions simultaneously. The tech sector's vulnerability reflects recognition that innovation cycles are accelerating and competitive moats are narrowing. The crypto market's evolution shows digital assets becoming institutionalized, regulated, and correlated, losing their revolutionary character while gaining mainstream acceptance. Geopolitical developments indicate that economic power is dispersing, creating both opportunities and risks that traditional models struggle to price. Most importantly, today's market behavior reveals that institutional investors are preparing for a world where adaptation speed matters more than size, where diversification across geographies becomes essential, and where the rules that governed the past 30 years of globalization may not apply to the next 30. The market is not just pricing securities today, it's pricing scenarios for alternative futures, and the signals suggest that those futures will be more complex, more multipolar, and more volatile than the world we've known. What does this mean for educated observers of global finance? It means we're living through a historical inflection point where understanding interconnections between technology, geopolitics, and capital flows becomes essential for comprehending not just markets, but the evolution of global power itself. The question that should keep sophisticated thinkers awake tonight: if today's market movements represent the early stages of structural change, what institutions and assumptions that seem permanent today will prove to be temporary products of a historical moment that is already ending? If this intelligence served you today, comment "The signal is clear" below, subscribe, and I will see you tomorrow with the next briefing.